the key valuations come from some of these, right? I'm taking 8 measurements that you need to understand before you, that you need to use in aggregate when you're looking at buying stock. Right? These are the ones that are valuable to me. Most experts will tell you they're very important. You should look at, and you're doing this for your final CCA. You pretty much filled out these tables, right? You looked at, for all your companies you invested in stock market game, the 3. You looked at competitors. You did some research on the valuation metrics, which this is all about. And in your reflection, you're going to tell me what you would do differently, if not the same, now that you know the metrics. Now that you know some of these on the balance sheet. Okay? Shares outstanding, market capitalization. The shares outstanding, you can finance@yahoo.com, or their annual report, right? Or the prospectus. But shares outstanding times market price, you can find that out on finance@yahoo.com. That gives you market cap. That will tell you the demand of the company and what they have. Market cap is an asset to the company. It's something that they can use to invest, right? Some of it. You then have net worth, or assets per share. That's the total value of the corporation. And how much of that value, or that net worth, you know what net worth is, assets minus liabilities, can be allocated for every share owned, per share. And that's good. You want a company that's of high net worth. Earnings per share, remember that? For every dollar earned by the corporation, how much of that can they allocate per share? You want the highest earning per share. Remember, you can't just look at one, but this is one of the most important. Right, guys? Debt to equity ratio. You'll find that on their balance sheet. You want to know how much of their debt, the ratio of their debt relative to their equity of the company, the value of the company. If it's high debt, be careful. Right? But then some companies normally, or some industries, have a high debt to equity ratio, like the automobile industry. They do a lot of borrowing, okay? But just be careful. I usually don't deal with companies that have high debt to equity. Price earnings ratio. The price relative to the company's earnings per share, right? If it's a high PE ratio, this is only useful when you're comparing 2 or more companies in the same industry, because industries have different price earnings ratios. But the beauty of this is, if it's a high PE ratio, it tells you that really what it comes down to is how much are investors willing to spend on a share relative to their earnings per share. If it's high, it's in demand. But it could also mean that it's overvalued. So if you're going to do short-term selling and buying, short-term buying or whatever, and then selling, yes, you're going to do a short-term investor, you might want the stock that has a higher price earnings ratio. Again, only valuable when you're comparing companies in the same industry. And it tells you how much investors are willing to spend on a share of stock per the earnings per share. It's a ratio, right? If it's low, it might have a lot of room to grow, right? If it's low compared to another company, you might have some room to grow. So then you got to go look at price earnings growth ratio. PE ratio is the past 12 months of data on the company. This looks forward out 5 years, right? Strategy, what they're going to get into, the businesses. Look at Apple, probably has a high PEG if they report it. Price earnings growth ratio tells you it's pretty much the same thing PE ratio does, but it's forward looking. You want to look at both. Tells you the growth. That would be a high figure that you want to look at. Dividend yield, we know what that is, right? That's percent of dividend you're going to get, right? That's the yield of dividend you're going to get, and that's usually calculated by taking, if you take a preferred stock, it's the percent of dividend you're going to get against the par value. A high dividend yield is what you want if you're interested in dividends. And then total return on investments. Remember that? You had to calculate that as part of Jeopardy. Remember, guys? That was your final Jeopardy. Some of you aren't taking the quiz nor the test because you did really well on Jeopardy, right? That's a gift. You earned it, right? That's the only thing you're not going to find anyplace. You've got to calculate that. And what you've got to do, and we did this, and it's very important because you want to know how much you're going to make on a stock before you buy it, or if you have the stock, how much you're going to make in total return, right? Are you going to get the investments you need, the money back that you need, right, for that goal? And that is, you have to look at your current return, which is your dividends. So you take the dollar payout value per share for the year, you multiply that by the number of shares, and you multiply that by the number of years you've held that stock, you now have what you made on dividends. Put that aside. Now you're going to go look at capital gain. You take the market share of the stock, multiply that, subtract that from what you paid the stock, what you paid for on the stock, multiply that by number of shares, you have what you call your capital gain. Add dividends to capital gain, you've got how much you will make on that stock. Pre-tax. Pre-tax. Okay? Now, if you want to compare another stock and what you would get today that you don't own, then like in economics, all things equal, you're going to make believe you bought that stock the same day that you bought the other one, and you do the calculation. You can see what your total return would be on that. Take a look. Remember, you've got to look at all these measurements in aggregate. You've got to understand the corporations that you're going to invest in, because you're going to be an owner, right? You buy a share of stock, you own part of the company there with Bill Gates, right? And every year you're invited to the corporate, the stockholders meeting. You pay your own way. You get a proxy, you get what you use to vote in or out the members of the board. You get a prospectus, which tells you all about the company in terms of its financials, balance sheet, and then you get an annual report. But you can also get this online. You go to the company, click on About Us or whatever, they have all that stuff except for the proxy. Okay, preferred versus common. I'm near the end here, right, guys? All right, let me talk to you about preferred. If you're interested in pretty much guaranteed dividends, go for preferred, okay? You will get dividends before common shareholders. If the company decides not to pay dividends for a period of time, either to reinvest or maybe they're going through some bankruptcy until they get back on their feet, when they get back on their feet, you're going to get those dividends before common shareholders. If the company is liquidated, you also stand the chance of getting dividends from that liquidation procedure, when they sell off assets, before common shareholders. If that's important to you, because that's your return on investment, right, then go for preferred. Dividends are predetermined, though. Here's the difference between common stock that I never shared with you, right? Dividends are predetermined. Remember, preferred stock has a par value on it, right? It's $1, let's say it's $80. You take the dividend yield, multiply the par value, that's the dividend you're going to get. It never changes as long as you own the stock. The company can grow. It could pay out dividends to common shareholders at a higher rate, right? Common shareholders' dividends can grow, but yours are not. So, what you're giving, the opportunity cost is you're giving up that growth in dividends. What you're getting is pretty much guaranteed dividends. Preferred stock. Last, no voting rights. You usually, unless the board of directors opens one up because of an important decision they want to vote on, you usually don't vote. I like to vote because I like to feel like I own the company, right? With common, dividends can grow with the firm. That's where you're making money, and you do have voting rights, right? Now you understand. So it depends on what level of risk you want to take. It depends on what you want out of this. If you want dividends, go for preferred. But if you really want growth in dividends, a little bit riskier, go for common. One more thing I didn't mention. Callback. If you own preferred stock, the company can call back that stock. They might offer you a premium, but just like bonds, they can call it back, right? They can call back that stock. And where companies make their money, not make their money, but reduce their liabilities is by calling back stock, buying it back. Because they owe you less in dividends. They reduce their liabilities. They look good on their balance sheet. Did you know that? Now you know. So if ever you see or hear that a company is buying back their stock, that's what they're doing. They're reducing their liabilities, increasing their net worth.